you so much. Next, I'm excited to introduce a special Bass edition of the chopping block. Hasseeb is running a few minutes late, so I'm going to take his place. And with that...
Woo! So everybody.
Hasseeb got a hair transplant, clearly. That's what happened.
He did. I just got back from Turkey. It's been great. Hi, everyone. I'm Hasseeb, the head hype manager at Dragonfly. Here we've got Tarun, the Gigabrain at Gauntlet, Robert Leshner, the czar of Superstate, and guest Avichal, the current driving electric. What's up, everybody?
Yeah. Happy Tuesday.
Happy Tuesday. Markets have been interesting. I don't want to make this talk about markets, but I think it would be behoove us to at least mention kind of what is going on. And Avichal, a few months ago, I think it was 6 months ago, you were warning that things were going to go very well, and then it was going to crash, and crash very, very hard. And if we could survive, then we would come out of it in a heaven of blockchain. Curious, do you think that this is what's happened? Or are we in this huge crash, or potentially is all of the money that's been raised by all of these large funds that you guys represent going to prop us afloat?
Okay, well, I should preface by saying you should never listen to anything I say, and it's not financial advice.
It's not investment advice
It's
or
not
life advice.
Yeah, not life advice. You should never, ever listen to anybody on this stage. Yeah, I mean, I think this part of the market cycle usually has a bit of a correction. People always get overly excited about what's happening, and then things pull back, and it's natural. Happens to coincide with rate cuts and, you know, the broader economic cycles, and that seems relatively consistent. So we don't trade, and so it's not like we're trading on this. And
Do you trade personally?
No, we actually have a pretty strict policy. And also, I don't know how you guys think about this. Like, I'm curious how Hasseeb thinks about this, but from our perspective, it's also sort of like an alignment with LPs thing. So, like, all of my money is in our funds. It also just makes, like, taxes easier. I don't have to think about stuff. So my life is very easy. I have, like, some treasuries and then, like, 90% of my assets in crypto. It just makes life way easier. But yeah, we don't trade on it, but, so we don't have, it's easy to prognosticate, but we don't really try to time these things. So nothing's changed about the long term as far as I'm concerned. Actually, I'm curious how you guys think about this, but I think the thing that people are not fully internalizing is how clearly it is the case, in my opinion, that crypto has won. Like, it's kind of game over because the structure of the market has changed with the ETFs. And once, like, BlackRock and Fidelity and Bitwise and all these companies have deep hooks into the roughly 60 or 80 trillion dollars of assets that previously could not access this stuff, those flows are just going to come. And it's going to be slow and steady. It takes a while for it to come, but, like, the market structure has changed. And so it's kind of game over now. And so really it's just, like, how long does it take and who the winners are? Does the US have a seat at the table or not? Like, there's some implementation detail questions, but it's kind of game over as far as I'm concerned. Like, crypto's won.
I mean, I think it's game over for a different reason entirely besides, like, the flows of finance. We currently in the US have one of two major political parties making crypto a core part of their platform, saying that they're absolutely in love with it. By next election, it'll probably be 2 out of 2. This election, I don't know. It might be 2 out of 2. We're not even sure.
Yeah. I think there's actually a good chance that it's closer to 2 out of 2.
Yeah.
I do a bunch of this.
There's a good chance that both political parties in America embrace crypto. And, like, the idea that we would have sovereign support for this by 2024 probably would have seemed crazy 2 years ago. Probably would have seemed crazy a year ago, even. Once you get to that level of adoption in terms of mind share and acceptance, I think we're headed towards a path of permanence.
As lovely and interesting as boring CFI TradFi shit is, not to me, I guess, but I think we should actually look at some of the bright spots. So there were at least 4 protocols that were perpetual dexes that did at least $1 billion of volume yesterday. So that is, like, the peak market share for on-chain volume, market share for perpetuals. So, like, I think we should actually look at the bright spots of everything went to shit and everyone went on-chain instead of going directly to Binance or going to other exchanges. Now, you can argue a lot of this is because of meme coins, right? Because all these people had meme coins just dumped and bought Sol on Sol perp exchanges. But at the same time, that is like real usage, that is real fees, that is real actual value that was generated out of like a relatively negative day. So I think we should you know, hang our hats on the fact that like DeFi did a lot of volume yesterday in a way that actually is making like on-chain stuff look much more attractive. And the second thing I would say is, you know, I didn't think that we would see someone close to a presidential campaign tweet about DeFi, but today you had Eric Trump tweeting about DeFi, which is like,
Wild.
you know,
It's so crazy.
He said he loves DeFi.
he said like it was amazing. It was like 4 hours ago.
Somebody asked him what DeFi protocols have you used, and he didn't respond to that tweet.
Yeah, it almost was like, did his Twitter account get compromised? Like, what's going on? It's like, that was like my gut reaction. I was like, this can't be real. The, you know, the other thing, I don't know if you guys saw this stat, like when Tether released their data around like treasury holdings, and it's now like, I think it's a top 15 treasury holder in the world. Like Tether owns more US treasuries than Germany, and almost as many as South Korea, which is freaking crazy, actually, that like one independent entity owns that much.
It's too big to fail.
Yeah, it's like, it's really wild.
I don't know. Well, I'm pretty sure the issuer of the treasuries can just rug you, but you know, in the long run. But I will say, I used crypto for the first time IRL in the last week. I was in the country of Georgia, where I literally went to a currency exchange where you could give them the local currency, and they would just send you Tether on Tron, of course, because you know Tron has product market fit
cheap.
in the Central Asian world. And the currency exchange would also hold your Tether and give you US dollar denominated yield, which I'm guessing is from DeFi. They wouldn't say,
Wow.
I also don't speak any Russian, and of course you.
So it's like a super sketchy bodega bank.
Yeah, bodega bank. That's like the correct way of thinking about it. But I was like, this is crazy. Like you gave them fiat and they give you dollar yield, which is like, I've never seen that before. It was like the
That's
first.
amazing.
You see that in like Argentina and parts of South America as well. But yeah, it's like little bodegas and.
I think the difference with Argentina is like it feels like it's more pervasive, that everyone is like collectively avoiding using the currency. But in Georgia, like people are paying with credit card also. It's just that everyone who's Russian who came in post-Ukraine, they have no access to the banking system, so they use Tether. And since they had such a huge influx of a Russian population, those people are just, you know, spending in Tether.
So, Hasseeb,
Oh, it's Hasseeb, the head,
No chair for me?
the head hype man. That's
You have
right.
been-
I was pretending to be you for a little bit.
yeah, Gil was pretending to be you.
Shit.
well-
Hello, everybody. Sorry for being late. I was coming from across town. What were we talking about?
Georgia.
The country, not the state. Using crypto.
Talking about Georgia?
Tarun went to a shady bodega bank
In Georgia.
in Georgia and used
Give
Tether.
them Lari, and they'll hold Tether for you and give you yield in dollar terms. So it's like a way. It's because it's basically like the Georgian population has increased a lot because Russian refugees moved there. The Russian refugees don't have access to SWIFT banks or credit cards. So like local Georgians or Americans or Europeans, whatever, are paying credit card, but all the Russians are paying in Tether. So it's like a very funny thing. But the POS systems will have a little QR code you can scan
And send US
I'm
dollars.
so curious to know what protocol under the hood is powering this. Like, if it's like some like the Sun lending program on Tron.
I definitely had to use Trust Wallet, so like it's definitely Binance. Let's be real.
You know, so this back to what you were saying before. The other thing that I think most people don't fully internalize is that the adoption of stable coins, when you start looking at some of these stats, actually has an impact on the U.S. government side of it too, because the U.S. dollar is a tool for national security as far as the U.S. government is concerned, right? It's like why we can do sanctions, because everybody's dollar denominated. And so U.S. dollar hegemony actually relies on the adoption of dollars, and this allows you to circumvent all of the banks and go direct to retail. So now you can like text somebody some dollars. And as far as the U.S. government is concerned, that's actually a fantastic use of crypto. And so it's one of the few things, like when we speak with Congress people or senators, like you just see the light bulb go off. They're like, wait a second, we can dollarize the world? Like, this is amazing. We should totally do this. And then, like, for a lot of people, it literally just flips them pro crypto. And you're seeing like the light bulb go off on that dimension too. So even if it weren't like ETF inflows, I think like the stablecoin adoption would just make the U.S. government flip pro crypto.
I totally agree.
I see.
We were talking about the market crash.
Oh, we were? Okay.
We had the TradFi side and the only one who talked about DeFi.
Oh, I see. We already talked about the yen carry trade and jump and all
No,
that.
no,
We
we
haven't
haven't.
talked about that yet.
No, we
That's
haven't
you,
gotten
that's
to the
you,
cause.
That's all you.
Okay. All right. Let me actually. So hello everybody. Sorry I'm late. How many people know the story of the yen carry trade?
I mean, this is a pretty well
I'm seeing
educated
about
audience.
like 30% of people know what's going on with the yen carry trade. Okay, so I think it's important to understand this because it's a big context of like why everything exploded and why everything is like recovering now today. Who wants to explain the yen carry trade? Robert, do you want to explain the yen carry trade?
Yeah, it's really simple. So for the last like 20 years or so, interest rates in Japan have been zero, like 0, not like, you know, America briefly after 2008 or COVID. Like they've been like,
Weren't they like technically negative 25 bips or something?
there was a little while where they were vaguely negative, but not in a way you could like get paid to borrow.
Yeah.
So like, anyway, interest rates have been zero. So pretty much most investors in Japan realized how easy it is to borrow at a 0% interest rate and basically do anything else, literally buy T-bills in the US, buy real estate in Europe, buy whatever. And so they would borrow yen at 0, sell it for other currencies, and buy other assets with it. And this has been wildly popular for like decades. Like this has been like one of the largest and like flows in finance globally is the yen carry trade. Borrowing yen for 0, selling it, and just praying that you earn more than 0.
And I just want to underscore this because I think a lot of people who don't spend a lot of time in finance maybe don't understand how insane that is. Like basically there's like a really, really rich Japanese guy who will offer you money basically for free to do anything all the time, okay? So like the US government tells you, look, if you park money with me, I'll give you 5%. And a Japanese guy is telling you, I will give you money for nothing. Just if you want money, here's money. That's what it means to borrow at 0. That's why it's so crazy and why so many people were borrowing from the Bank of Japan to do all sorts of other things. And one of the places into which all that borrowed money from the Bank of Japan came to is US equities, crypto, and just basically everything. Like almost everything got some of this Bank of Japan money.
Yeah, pretty much.
So the Bank of Japan raised interest rates from 0 to 25 basis points, and that was enough to cause huge cascades of margin calls, tons of people having to buy back the yen that they had to go pay back their thing. You know, people were basically doing this yen carry trade and taking very, very small margins, and those margins turned negative when the yen increased in value and when the interest rates went up, and that just caused tons of forced selling.
Well, there's a confounding factor here, which is that like when you're selling the yen to go do something else, you're taking currency risk, and so like if the yen dollar ratio moves against you, you need to pay back a lot more yen because you're now sitting in dollars.
But
And
the
so-
yen's been getting weaker for like decades.
Yeah, until it wasn't for the last 3 weeks.
Exactly.
And so it was like a slam dunk to borrow, and you're like, whatever, the yen's going to get weaker or go sideways. And so if you were borrowing at like 150 or 160, you just got hosed when it went to 140.
So what I love about this is that this is so recognizable to crypto people.
Yeah.
Right? Like if you just explain that, it's like, oh, that makes so much sense. Like we totally went through that.
It's Luna.
In 22.
Yeah.
Exactly. Like this is the most crypto thing I've ever seen happen in traditional finance. You know, where it's like, oh, that was foreseeably kind of a lot of leverage to have over like one thing, which is that the Bank of Japan will never raise rates. And then it raises rates a little bit and like everything explodes. We have one of the worst days in financial markets in years. And everybody's like, oh my God, the world's falling apart. And then today, like everything whipsawed back because everybody just reloaded and had more money. And they were like, yeah, that actually had nothing to do with the fundamental value of anything. It was just a bunch of hedge funds like dumping everything because they had to meet margin calls. So one of those hedge funds that was dumping everything that had to meet margin calls is jump trading. And jump trading, some of you might remember from like everything in crypto over the last 3 years. So they're one of the biggest, probably the single biggest market maker in crypto. And you know, we can see on chain that they have just been mass dumping almost everything that we know they own. And then there's a lot of, whatever, speculative theories about why they're dumping everything. But we know they're dumping everything, and we also know they do a lot of market making outside of crypto. So it's very likely they were probably exposed, were getting cheap funding from the Japanese guy, and as a result, now they have less cheap funding, and therefore they need to raise cash to meet their other obligations.
Do you think this is a temporary thing? Like it happened to bounce back 10%, and actually there's just a bunch of skeletons and dead bodies that we haven't uncovered yet, like people, who are about to get blown up if this just moves in the wrong direction? Or is this like, oh, it's fine, like...
Well, so everybody seems to think there's more unwinding to happen, right? Like if you just look at the net amount of leverage of people who are still exposed to the yen carry trade, there's still a lot. And usually, like, if you unwind a carry trade, normally you want to like take your time. You don't want to just like mass dump everything into like this big rebound. So already like the yen has come back down. The Nikkei is, they lost 12% on Monday. Now it's up 10% today. So like, it's like, okay, did the value of the Japanese stock market really go down by 12% in a day? Probably not. Probably that was forced selling. So there is some modulating back to normal, and then people who have the time preference can say, look, I don't need to meet all my margin calls today. I have the balance sheet to absorb it. I can take my time. So there will be more selling as people unwind from this carry trade that's turned unprofitable, but it's not going to be as chaotic.
Arguably, this is actually a place where CeFi is better than DeFi. Like the cascading liquidity. Well, because there's like some human judgment in the mix here, which is like, oh, the asset value of these things actually didn't change. Like, I don't need to call you right now to like dump this thing.
Well, no, we had the TradFi version of that in crypto the last cycle where everybody refused to margin call 3RS Capital because they were oh, they're such a good client.
Totally.
We can't margin call them. And that like was even worse.
Well, and I don't know if it's
That's
better
where
or-
the skeletons are. Is these people who are actually zombies right now who are only going to be zombies when NVIDIA goes down another 20%.
Totally. Yeah, so I don't think it's maybe better or worse is like the wrong framing, but there's like a different trade-off here, right? Which is like when an individual is underwater, you want to be able to call them. When the entire system is underwater, you kind of want to be like, all right, guys, we don't need to margin call everybody right now, and everybody's forced to dump all at the same time. That also doesn't feel so great. And so in the like Three Arrows case or the FTX case, like DeFi is better because it gets paid back first, and you can't stop it. You're going to get forced. And actually in the like Japanese yen carry trade, it's like, really? Is like all of Japan bankrupt now? Like not really. Like maybe we should just halt. It's kind of an interesting, like at the systemic level, it actually probably was good that they halted the
So
stock
this
market
is
for a
an
day.
interesting question because in any event in traditional markets, whenever markets move too quickly, you get trading halts, and they're like, no one's allowed to trade. Something weird has happened. Everyone regroup. Just sit down for 15 minutes and like talk amongst yourselves, and then we can resume trading. And I don't, I can imagine that this came from probably like, if something moves that fast, maybe there's a glitch, maybe there's like cascades, maybe there's something, and like if you just pick up the phone and talk to the guy, you can fix it. Nowadays, there's no picking up the phone and talking to a guy. It's like all algorithms all the way down. So like the algorithms don't care about, they don't care if like, oh, this looks unreasonable. It's like, well, whatever, my algorithm says to do this. So one question I have for you guys, being that you two are like sort of the DeFi people every day, DeFi does not have trading halts, right? If something goes down really fast, it's like, well, that's the market clearing price. That's what markets do. If you think it's wrong, go buy it back up. Do you think that trading halts are useful? Do you think it's good that DeFi does not have the concept of trading halts?
Well, there is and there isn't. So I'll just use personal experience here. So early on, the Compound protocol had essentially trading halts built into price feeds. And if anyone was around during Black Thursday 2020, where the shit really hit the fan, there were the concept of circuit breakers for the price of stable coins, including the price of DAI. And this is when DeFi was smaller. I mean, like MakerDAO was like $100 million or something like that. And Compound had like $70 million in it. Like DeFi itself was tiny. The TVL was like sub 300 million for all of DeFi. But the concept of circuit breakers is actually what prevented any bad debt from occurring during Black Thursday.
Yeah, so this is for oracles, right? The
For
circuit
oracles,
breakers on
yeah.
the oracles. But what about
Totally.
trading?
No, there's no circuit breakers for trading in any protocols at this point. And I think that's actually a feature because most of the degens who are trading on DEXs don't want to be told the price is moving too much, you can't trade. That's like the best and most fun time to be trading.
I mean, I think there's a question of like, what does it mean to halt? So the traditional finance halt is sort of a discrete jump. Continuous trading, absolutely no trading. Most things in DeFi have some type of retardation mechanism where it's either like the fees go up, or the insurance fund VIG goes up, or the calculation of how the funding rate is computed implicitly slows things down, right? Because like when you see a 5,000% funding rate on some shitcoin, on some shitcoin meme coin, like, yeah, who's taking, well, someone is losing that 5,000, right? It's not just strictly winning. And so there are a lot of the mechanisms that actually do well in crypto, especially because you have 24-hour trading, there's no built-in notion of halt. So one thing about trading, when, you know, I used to trade Japanese futures, and to Hasseeb's point, there was like no, it was the opposite of CME futures. CME futures were filled with all these like random dudes in the Midwest who had a farm who would like punt fucking corn futures in the middle of the day. Japanese equity futures was literally only HFT firms. Like it was only people who were co-located. There was no like guy punting idiot like farmer person, whatever, right? So that just didn't happen. And I think in DeFi what you instead see, and in crypto in general, because there's no time scale, there's no opening auction, there's no closing auction, everything is continuous, you end up finding mechanisms that are better for continuous time trading, even in centralized crypto, work better, right? Like why did perpetual futures take off? In a lot of ways, it's because you can hold this continuous time position without actually knowing your exact duration ahead of time, because it's such a volatile market, being able to predict how long you want to hold a position is already too hard. And so I think in DeFi, over time, what's happened is people have found better mechanisms that they don't have this notion of a 0-1 halt, but they have a notion of like a continuous halt, especially in the perpetual dexes. And I think we saw their outperformance yesterday in getting to $4 to $5 billion of volume, coming from those mechanisms getting a lot better.
So is your claim then that, so Robert made an interesting claim, which is that part of the reason why dexes are continuous trading, they never turn off, even when yen is collapsing, equities are collapsing, crypto is collapsing, and it's like, yeah, you can trade that every moment of the day. Part of the reason why you might do that is because degens like it, and it's actually like a product feature that you're outcompeting your competition that turn off the trading, even if it might be better for quote-unquote market integrity or something if trading were discontinuous. You're like, well, but the degens like it and we're going to outcompete. And so in some sense, like the NASDAQ can do that, but you know, crypto is like, well, you know what, we're not operating a monopoly. So
Well, the NASDAQ can't do that. So like even the best, most run high-tech TradFi company still has to have people coming to work and servers and all of this. And every once in a while, you still have to reboot the servers, and you have to like clear the garbage out of memory, and you have to like have an off period. Even if it's a small off period, you're gonna have an off period no matter what if you're running things on traditional servers with humans that work shifts.
Sure. But so, Tarun, it sounds like your claim is that TradFi would be better off if they move to this more, instead of continuous, discontinuous, you just kind of back off on the fees, or you back off on the...
I think at some level, having this discontinuous thing is basically saying people on a certain part of the risk spectrum don't get to express their opinion. And any alternative financial system that doesn't have any rules like, hey, we shut off at a certain time, or you have to have a time preference at a certain time, should allow that expression.
I think part of it is also avoiding these kind of margin call cascades, right?
Yeah.
Which is that if you have these flash crashes, which is basically what happens when not enough liquidity concentrates and people can't regroup. I mean, that's a theory anyway. So if you remember, you know, there were all these agreements. I remember during COVID, when there was the massive crash in real estate prices, right? Basically, everybody kind of like handshake agreed that we're going to sort of pretend that our real estate asset prices are frozen, and no one's going to margin call anyone, because if not, like we kind of all die together.
There was a phrase for this. It was amend and pretend.
Amend and pretend.
Where you amended your existing contract.
I mean, in
and
effect,
it didn't go down.
In effect, that's solving for an Oracle bug, right? What it's saying is like, we all kind of know the thing is not worth what the market claims it's worth right now because it's a forced situation. And so these things are probably worth a lot more. So it is actually, in fact, an Oracle bug that you're sort of accounting for. It also, I don't think that wasn't the original intent probably, but like it comes as an outgrowth, as a side effect. It's like very similar to the DAI situation, which you're kind of like, I'm sure, right? It's like $1 is $1.
That's like hard coding DAI
Yeah,
at
you're just
$1.
hard coding. You're like, I know $1 is worth $1. And so like, if you tell me it's not worth $1, like that's a bug.
The exact implementation was, if the market thinks it's above $1.05, it's $1.05, and if it thinks it's below 95 cents, it's 95 cents. That was the Oracle limitation.
Yeah. So, but it's an interesting question though, because I don't think it wasn't necessarily a purposeful design decision. It came just as an outgrowth of what technology could do and what humans could do. It's just sort of a side effect of the way things worked, you know? So it's sort of an interesting question. I guess one way to ask the question you're asking, Hasseeb, is if you could redesign those systems today, would you redesign them to be continuous instead of with these discrete drop-offs? And I don't know if actually the legacy institutions could handle that, actually.
No, they can't handle that.
Yeah.
They can't run 24/7, period. Like a blockchain, the one thing it's actually good for is being able to continuously 24/7 create new blocks and validate transactions without downtime. I mean, Solana
I'm
is
resisting
an
the urge
exception,
to make a
but-
Solana joke.
Yeah, I'm making the Solana joke. But Bitcoin,
Hey,
Ethereum.
Solana performed well.
It
Yes.
did, it
I
did. It
don't-
performed very well.
I
It
know,
performed very well.
you're a Solana hater, but I gotta say,
I am, for the record.
made 5 times the number of transactions on Solana yesterday than I did on any L2. Because I actually had RPCs down on L2s. I couldn't get any transaction.
Yep.
Everything on Sol worked
No,
perfect.
Solana did very well, and they turned back on Ore or something. Ore relaunched.
Yeah, Ore
Ore
right.
relaunched yesterday, which also was very impressive.
Yeah, but a blockchain theoretically can run 24/7 for like 10 years without interruption, which is a technical feat all on its own that has to be like admired and revered. Like Bitcoin has been basically
Yeah, it's
running
remarkable.
continuously since launch,
Yeah, it's
with like
remarkable.
1 or 2 minor issues, you know.
Yeah. Well, it is also, it's just like another manifestation of the, the Clayton Christensen disruptive innovation thing, which is like AMMs were like good for this weird set of stuff, long tail, permissionless assets, and they kind of suck in so many ways. And then the tech just keeps getting better and better and better. And now you look at it today and you're like, actually, like Solana and the L2s, and like you can actually support pretty high throughput, and it's actually maybe better than the legacy markets. And that is like the tipping point where all of a sudden you're like, well, shouldn't all the markets be over here?
Eventually, yeah, they have
Yeah,
to.
they have to be.
But in like 20 years.
Yeah.
There's so much like inertia to TradFi.
Yeah.
It's crazy.
So you were talking about the layer 2 RPCs were kind of falling over. Solana did fairly well. Let's briefly talk about sort of, every once in a while we get these big stress tests of all the infrastructure that we've built over the last period of time. And how would you guys grade just things that you saw in the ecosystem that, like, thumbs up, did really well, thumbs down, this one didn't really go the distance?
I mean, crypto across the board did really well. Not like the prices of crypto assets, but like crypto systems across the board
A+.
did phenomenally.
Yeah, A+.
Everyone in TradFi was like, my brokerage account won't work. Like there was like widespread reports that almost every US brokerage was like failing, right? And yet almost every system in crypto like unequivocally worked. There's so few reports of any incidents of any kind. And
Yeah.
so we're now at the point where like genuinely DeFi is significantly more robust than TradFi, period.
That's a wild statement if you think about it. Like
Yeah,
if 5
why?
years ago you'd made that statement that actually DeFi
No, you would have
is
sounded
legit.
crazy.
Yeah,
if
but
you
it's
said
legitimately
DeFi
better.
will be more robust.
Yeah, it's legitimately better.
5 years ago, the biggest on-chain pool was ETH DAI. So,
Yeah.
it's like,
Yeah, but it's pretty, I mean, we talk about this a lot internally, and we talk about it with our LPs, there's this adage, I forget what it's called, but it's humans dramatically overestimate what's possible in 2 years and dramatically underestimate what's possible in 10. And if you go back to the 2017, 2018 cycle, everybody was like, oh, we're going to have all these things, and DeFi is going to be huge, and stable coins, and like L2s. RWAs, like all, like decentralize all the things and all the ICOs. And there were like, a lot of them were good ideas. And then by 2020, everybody was like, this is stupid. Like, why did we ever think any of these things are going to work? But we're now like 6 years into it. And so it's actually, we're like exactly at the part of the cycle where everything is technically possible. And so the next, I think, 5 years are people just realizing it and making all of those same ideas from 2017 actually happen this time. And it'll just be this like sense of disbelief this time around. It's very similar to if anybody, I think the internet 1.0 bubble was just a little bit before all of our times, but it's like all the same ideas from like the late 90s popped up again 8 years later, and then it was actually the right time to do them. And I kind of feel like we're hitting that zone now where like all of the ideas from 16 and 17 are now actually technically possible. And so we should just redo them all and they'll actually work this time.
So we finally have IoT blockchains, what you're telling me? The tangle,
Where's
the
Eric
tangle
Wall?
is coming
Where's
to
Eric
life?
Wall? Where's Eric Wall? You say IOTA 3 times, he'll show up.
Yeah.
But I'd say I'd give it an A-. This was one of the best crashes, honestly. In best meaning
We
like
need to get a rating, a Tarun rating of best crashes in crypto.
this one was very clean.
It's a good Asian dad.
The only real things that we monitored and saw were sort of some loss of liquidity in some pools where like it was kind of a little bit dangerous, but no real cascade risks.
When you say loss of liquidity in pools, what do you mean?
Like a bunch of market makers like pulling liquidity from AMM pools.
Should they not be doing that? That seems like a good idea.
Well, it's not good if there's loans getting liquidated at the same time.
Oh, I see.
Yeah.
Okay, so the liquidations weren't getting filled with
But,
liquidity.
but for the most part, actually, things were pretty good. Even all the decentralized stablecoins actually look quite good. The only thing that the reason I give it A-, the ding is on, I think the Oracle latency distribution, if you look at the tail, is horrible. I think some of the oracles are not.
Can we call out some oracles here?
No, some of the longer tail oracles, I think.
Longer tail oracles. Come
Name
on,
them.
you got to
Name and shame, baby. Name and shame.
You got to work on your P95 latency. That's all I got to say.
Come
Name
on,
and
we
shame.
need a little bit of alpha. A little bit of alpha. Come on.
It's just more that like, in a world of 500 L2s, there's some L2s where every oracle was, 10
Which
times
L2?
slower.
Okay.
You have to tell the audience. Come on.
I'm not trying. I'm just trying to say this is where people could get better. I'm not trying
Okay.
to.
Are these your customers? Is that why you're not willing to?
No, I'm just like
Okay.
trying to point out that there's some idiosyncratic.
So please do your own research. Find the L2 that sucked.
And short the
tweet it
oracle
Tarun.
tokens.
Yeah, be like, Tarun, I found it.
Yeah.
There you go.
Wait, was it-
scavenger hunt? Scavenger hunt.
Was it? Were you saying that the L2s? Or was it you're saying that the oracles?
No, the oracle's submission and if you look at the oracle prices posted on every block versus median across centralized and also say Sol and ETH.
Yeah. So, but is that an L2 issue or an oracle issue?
I think it's an oracle submission issue, not the L2.
Interesting. And was it on all assets or is it on long tail assets that you think it's an issue?
Lower liquidity assets, although on lower liquidity L2s, the oracle updates were very late.
Got it. Well,
I would not be an LP.
Come find Tarun
I would
after.
not be an LP.
Yeah, find Tarun afterwards. You want to know which tokens are
Well,
short.
the reason I'm sort of probing is I'm trying to get my head around, like, if they're truly long tail assets, in my head it sort of goes, like in TradFi it goes to like, there are lots of illiquid assets where you can't trust the oracle price. Like, think about LPs in a venture fund, right?
I think when I say long tail, I mean not in the top 10, but in the top 100 by market cap.
Got it. Yeah, I mean, I think of all
Anyway,
those as like,
We're
I think the
at
prices are fake
time.
anyway.
We're at time. Unfortunately, we have to wrap. But we do always like to end Chopping Block with a little bit of alpha. So please come chase Tarun, ask him for his recs on what tokens are short. And appreciate you guys
I
being
never
patient with
give
us.
financial advice.
Except
life
now,
advice.
except now. There's the
Only
one
life
exception.
advice. No
This is the one
financial advice.
exception. He will give financial advice once he's off stage.
Yeah.
Thanks, everybody.
Thanks, guys. That was awesome. And now we have our last session, which we're excited to have. It's an on-chain assets panel with Nathan Ullman, founder and CEO of Ondo Finance. Rob Leshner is going to stay here, CEO at Superstate, and Shochi, Chief Ecosystem Growth Officer at Cello, and also one of the organizers that helped us put this together.
Hey everyone, welcome. As I mentioned, my name is Sochi Cazador. I lead ecosystem growth at Cello. For those of you that don't know, Cello is a soon-to-be L2 that is focused on real-world use cases. And couldn't be more thrilled to be here up on stage with these two OG leaders in the space, with Robert Leshner, CEO of Superstate, and Nate Ullman, CEO of Ondo Finance. Yeah. So talk about, I think, a crazy few days. I'm sure that you guys talked about it a little bit earlier on stage as well. It's been significant volatility, not just for crypto, but obviously the global stock markets as well. RWAs play this really interesting role in helping decentralize finance. Wanted to start by having you guys talk a little bit about your projects and what you've been working on.
Sure, happy to start. Yeah, I'm Nate, so I'm the founder and CEO of Ondo Finance. We are in the business of tokenizing so-called real-world assets. We have a special focus right now on cash and cash equivalents. So we have a short-term treasuries fund that's accessible to US and non-US accredited investors. And then we have a de facto permissionless yield-bearing token backed by treasuries that can be traded and used very similarly to stablecoins, but that pays its holders a yield. And we also recently announced our plans to get into the tokenization of other public securities, equities and bonds that have existing deep liquidity, and plan to unveil that in more detail later next year.
Woo! I'm Robert Leshner. I'm the CEO of Superstate. Superstate's an asset management firm and technology company that's creating investment vehicles and tokenizing them and bringing them to blockchains near you.
Awesome. So let's zoom out a little bit and just talk about RWAs in general. Would love, just maybe Rob, you can kick it off. What are RWAs? What are examples that we're seeing in the space? You touched a little bit on them in your intros.
Yeah, well, I personally actually hate the phrase RWA. I'll explain what it is first, and then I'll explain why I don't love it. RWA stands for real world asset, kind of implying that everything native to a blockchain is a fake asset or a fake world asset, I guess, of some kind. But in general, RWAs, the concept of it that's colloquially accepted is creating on-chain exposure to financial products or returns or assets or things that don't get born on blockchains. Most of the tokens that get created for the last many years, going from Bitcoin in 2010 to most things up until 2023 or so, were issued on blockchains for the first time. There was no offline asset ever. It was just here's my project. We created a token for it on the Ethereum blockchain or on Solana or on whatever blockchain. It only lives on a blockchain. It's in the blockchain bubble. And RWAs are saying, well, how can we take this thing that currently probably is recorded in its ownership off-chain, whether it's in a spreadsheet or some legal contract or some right, and then bringing that on-chain. There's so many different approaches to do this. There have been so many experiments over the last couple of years, but it's still in its infancy. There's not that many assets that have been brought on-chain yet. There's been a lot of ideas. People sort of expected by now we'd have real estate and stocks and all sorts of things on-chain, but we don't really yet.
So just building off that a little bit, just to give the audience more perspective, what are the benefits of tokenizing assets?
You want to take it?
Sure. I think it depends a lot on the type of asset that we're talking about. To Robert's point, there's a lot of different flavors of so-called real-world assets. If you look at the history of the space, I guess dating back to, in 2016, there was a lot of enterprise investment, and at the time, they're calling it distributed ledger technologies, and then in 2018, we had a big security token wave, and all of that was really centered around the thesis that by tokenizing assets that are historically relatively illiquid, like syndicated loans were a big focus for a while, or real estate or private investment funds, that because tokens can be transferred and settled very quickly and cheaply, that would bring more liquidity to these assets. I think there's a little bit of a kernel of potential truth there, but I think in practice, what we've seen over the years of this sort of experimentation is that, it's not a technology problem that is the limiting factor to the creation of more liquidity in these sorts of assets. It's, more fundamental, about a lack of digitization and automation of, the documentation behind these sorts of financial assets, challenges around how to price them well, issuers not wanting these assets to be traded, regulation, and, I can go on and on. And so these efforts, which have extended to investing, many companies raised hundreds of millions of dollars, T0 comes to mind to build these, ATSs, these secondary marketplaces to trade security tokens, and, none of that really got anywhere. And so I think, more recently, the space, and, certainly we have been very focused on tokenization of assets that already have deep liquidity with a very different potential benefit in mind, and that benefit is really taking advantage of on-chain programmability and making these assets usable in this on-chain financial ecosystem, which really was built in earnest in 2020 with the likes of compound finance in what was at the time an extremely crypto native use case, right? I mean, facilitating leverage on crypto, trading of long tail crypto, et cetera. And I think we built all of that infrastructure in this sandbox environment, and now the industry is focused on repurposing that for traditional regulated securities.
Here's the best example I'll give you. You all use tokens, they're awesome. You click a button and like 2 seconds later, someone else has the token. You've literally moved assets pretty much anywhere in the world, basically instantly and basically for free. If you look to like other markets, the worst examples like in TradFi is like if a hedge fund wants to trade a bank loan or a syndicated loan, the process to change the ownership takes like 4 weeks and like $30,000 of legal costs just to like move an asset from their books to someone else's. And everything in between, tokens are super fast, quick, cheap, awesome, to horrible old TradFi. This is the way you move ownership of an asset. That's the opportunity for bringing assets from the boomer world on-chain.
So I want to spend some time talking about the growth, but before we go into the growth, we need to talk about, I think, what's happened over the last few days. A lot of volatility, I think largely in part to the unwinding of the yen carry trade. There's been increased focus on risk associated with basis trades and leverage positions. Robert, what is a basis trade?
Oh, a basis trade is really interesting, and this is very similar to the yen carry trade that we were just talking about on the Chopping Block Live. The concept is very simple. You buy one thing and you sell the same thing at a different time at a different price. This is used in currencies, this is used in crypto, this is used in commodities, but the basic concept is, at least in the concept of crypto, what's been happening for years and years and years, very popular, people will trade the difference between Bitcoin and a Bitcoin perp, or Bitcoin and a Bitcoin future, or Bitcoin and some wrapped Bitcoin running on a specific blockchain like Ethereum. All of these different products that represent the same underlying asset have price differences, and the difference between those products, which all look pretty similar, are a type of basis. Basis is the difference between an underlying asset's different incarnations of itself.
Do you think there's a way to avoid the risk? And how have you thought about this?
Well, it's funny because risk is opportunity, right? And like arbitrage is opportunity, and like price differences exist, right? Like a great example is like we have Bitcoin. The price of Bitcoin is different on Coinbase and it's different on Binance. And there's a lot of reasons why it's different on Coinbase and why it's different on Binance. And if you understand those differences, you could probably build a hedge fund or a strategy or a profit-making opportunity around exploiting that one specific difference when you understand it well enough. And that difference is an incredible opportunity for you. But that difference also exists between Coinbase and a Bitcoin ETF. And not just one Bitcoin ETF, there's like 8 Bitcoin ETFs that all trade. And the underlying implied price of Bitcoin is different for all of these products. And we're just talking about Bitcoin here. We're not even going into like all the other crypto that exists, right? Like just Bitcoin, there's like 80 different prices for Bitcoin. You just have to learn how to exploit it. And obviously that opportunity can be misunderstood. It can be mismanaged. It can be over-levered, right? Like one of the best examples of this for anyone who's old is in the 90s, there was a hedge fund called Long-Term Capital Management that found this very small price difference between US Treasury bonds and said, oh, well, if we can make 2 basis points reliably and lever it up like 1,000 to 1, we'll make a whole lot of money. We'll make like 20%. Why can't we do that? And they did do that, and it worked really well until it blew up and almost brought down all of finance. So yeah, there's risks in like price differences, but for the most part, those differences are opportunities, especially when they're well managed.
Nate, I'd love your thoughts on this too, like just the volatility over the last few days. Like, what do you think that means for RWAs in general?
It's a great question. There's a lot of different angles to take that in. I mean, I guess, first off, to the extent that it means that we might get rate cuts more quickly than was previously anticipated. I mean, I get this question a lot, given that our main product is tokenizing US Treasuries, like how we think falling rates would impact our business. And it might seem like at face value that would be bad for us, but I think we have to keep in mind that we're competing with products that pay holders 0% interest, and so there's quite a lot of margin regardless, and broadly, rates falling is good for risk-on assets. With respect to like macro volatility more broadly, I mean, real-world assets are super diverse. Like there's risk-on and risk-off assets, and great potential diversity for folks to hold on-chain regardless of market conditions. And I do think it is very much a hedge and a diversification for the industry to get assets that are more widely held in a downturn on-chain. I mean, as we've seen historically in bear markets, like in the wake of the Terra collapse, I mean, the DeFi ecosystem was kind of a ghost town because there was no demand to lever up crypto assets, no trading on long tail crypto assets. And so, during times like that, we need more diverse off-chain assets to be available.
So true. So let's talk about the positive. The RWA space has seen incredible growth. I read somewhere, I think 3 times or 3x in the last year alone. McKinsey is projecting that the total tokenized market could reach $2 trillion by 2030. Their bullish scenario is up to $4 trillion. We've seen also in the traditional crypto space, or not traditional crypto space, but in the crypto space as well, more treasury moves in terms of diversifying their assets using RWAs. Your both projects were awarded from the Arbitrum DAO, and I believe also putting in submissions for the Maker DAO as well. What do you think is driving, I think, the growth in general and the sustainability of it? Would love your thoughts there.
Well, I'll just preface by saying I think we're in chapter 1.5 of RWAs. The market is still crazy small. So we're so early that there's no cause for celebration yet. It's just tiny right now. We're incredibly early. Yes, there's been incredible growth over the last 1.5 years, but to put things in context, this incredible growth, we're barely over $1 billion. I mean, compared to the size of actual big markets, right? I remember when people were like, oh my God, TVL in DeFi hit $1 billion. And it was and everyone's like, oh my God, it's $1 billion. And then it was okay, well, yeah, it hit 100 billion not that long after, right? And I still don't even think 100 billion is worth celebrating, because in the scope of actual markets, that's still small. And so, just to put this in context, I think where we're at right now is in its infancy. And there has been tremendous growth, but we are at roughly 1% of 1% of where I think we're going to be in 30 years. The question is, what's the next 30 years of transition look like?
Yeah.
Yeah, I mean, I certainly agree with that. I mean, the tokenized treasuries as a whole are barely $1 billion now, and yeah, there's $5+ trillion just in U.S. Treasury money market funds alone. So we're very much laying the plumbing for all of this. To date, most of the growth has been in treasuries, and at least from what we've seen, most of that's been coming from folks who are otherwise in stable coins.
Yeah.
And stable coins really are meant to be used as a payments instrument and not to store wealth for long periods of time. So counterparties like foundations for crypto development companies, high net worth individuals within the space are moving some of their long-term holdings, if you will, into tokenized treasuries, and that's a nice start. But yeah, very much look forward to getting more diverse assets on chain, and starting to make on-chain finance look more like traditional finance, including in scale.
So let's talk about kind of like some of the barriers. What's holding us back from being able to achieve that at a faster pace?
I mean, I think it's diversity of assets and liquidity. I mean, we've just had so much adverse selection in what's available on chain. It's like poorly priced private credit that can't be sold to traditional investors. And yeah, there just hasn't been great assets. And similarly, because those assets haven't had any real liquidity on chain, there hasn't been utility for them on chain. So they haven't been usable in on-chain financial lending, derivatives, et cetera, applications. So investors like take some security token, hold it to maturity, and they're like, great, like what was the point of that being a token in the first place?
Yeah, I agree with all of the things Nathan just said, but I'll add on to it as well. So everything he said is 100% correct. On top of that, most people still don't really know how to use a blockchain or want to use a blockchain. And like this cannot be like minimized the importance of. This is like actually a big deal. Most of the largest wallets in the world or balance sheets in the world are scared shitless of blockchains because managing a private key is scary. Even working with a custodian is scary. Like the way you physically interact with assets on chain is so fundamentally different than the way you interact with assets in the way that people are used to that we're not even able to address most of the market yet. Most of the market is still scared shitless of blockchains.
So speaking of the traditional players in the space, we're seeing moves, I think some baby steps, as you would say. Recently, BlackRock CEO said that the next step going forward is the tokenization of financial assets, which I thought was like huge, just to have that level of endorsement. What do you think about some of these larger players coming in the space, but from the perspective of native builders? Like, so what distinct advantages do crypto native builders have in this space?
It's an interesting question. I think the biggest advantage that crypto native builders will always have is a familiarity with the environments and ability to understand the ecosystems better and ability to network and ability to move more quickly and ability to out-innovate. I think like this is something that comes up in almost every industry where an incumbent wants to do something. And maybe half the time, and like a big incumbent is like best equipped to tackle something new, but not always. And I think it varies considerably.
And Nate, your background is amazing, having spent a lot of time in traditional finance on the digital asset side. But curious kind of your thoughts on this, and also how do you think about the differentiation, I think, of some of the offerings there versus the offerings of like Ondo?
Yeah, I mean, I definitely agree with Robert. I mean, having worked on the digital assets team at Goldman, I can say it is very challenging to, really innovate within a large organization like that. It's super exciting to see asset managers in particular, like BlackRock, tokenizing assets on public blockchains and doing so in a way where the tokens have meaningful utility, like they can be transferred and that can authoritatively affect transfers in ownership. But yeah, when we speak with them, they really see the value from us in helping with distribution. They're a little bit limited in how they can tap into DeFi protocols and wallets and exchanges and how they can expand to a whole bunch of different public blockchains at once. And those are areas that I think more crypto native firms can add a lot of value.
And on that note, there have been a few announcements from Ondo, like interoperability being a big focus, expansion into the Cosmos ecosystem, I think just happened last week. How do you both view the role of interoperability in the RWA space?
Yeah, I mean, there's still a lot of friction in managing a real-world asset, particularly one with permissioning requirements across a whole bunch of different blockchains. And we have to be particularly paranoid about security. And so we really try to avoid reliance on any single bridge provider our other key infrastructure, and we build a lot of redundancy around that. And it's definitely been challenging to scale in a way that makes sense. And so I think that's sort of a big area where we'll see certainly some abstraction and innovation.
How about you, Robert?
I agree.
All right. So any plans to go multi-chain? Yeah.
Yes, of course.
All right. Okay, so looking ahead, wanted to spend some time thinking and talking about some of the technical innovations. Like, what do you think will have the biggest? You touched on it a little bit, I think, with the diversification of assets and liquidity. But as you think ahead to the next 2-3 years, yeah, what are you thinking about for your respective projects?
Sure, yeah. I mean, I think I was touching on it a little bit, but I'd say interoperability and let's call it chain abstraction is one area that is exciting to us. But really, by and large, I think there isn't that much, like, certainly hard tech innovation that's required to, make real-world assets on-chain a big success. I mean, I think our industry has been investing, almost exclusively in tech innovation or very, very heavily in tech innovation for a long time. And we really have, a lot of phenomenal building blocks now, and it's just sort of a matter of putting the pieces together.
Have anything to share on what you're thinking about for the next, some alpha maybe?
Yeah, maybe not quite yet, but there definitely is some infrastructure that we're building to address some of these challenges around going multi-chain and managing real-world assets in that sort of context.
So in the audience, we have a large amount of students and builders. Would love to hear maybe some inspiration. What are things that you would like to see built in the RWA space that could complement Superstate and Ondo? Like, what would you put out there for these students and builders?
Ooh, great question. I guess I'll go first. The challenges of RWAs versus like DeFi in general come down to a bunch of things. Like, compliance is, for good reason, really complex and difficult. There needs to be way more solutions there. It's one of the biggest limiting factors for actual interoperability. So solutions there are really interesting. Data is one of the things that I think there's a lot of opportunity in. Like right now, there's very little or not enough insight into the actual products, what's in them, why, how do they work. Like, if you compare it just to like TradFi, like the amount of like information that's available is, I think, lacking. So like,
What's an example?
well, a great example is like, we as Superstate like try to publish like the individual holdings that go into, one of our tokenized products. But that information is in Web 2. It's not like machine readable in a lot of ways. Like, it's not usable on chain. It's not accessible to an on-chain system that might want to arbitrage 2 tokens or like use 2 tokens or figure out how to like automate them or program them. If you look on chain right now, the tokens that we create essentially look like a dumb ERC20 token, right? That you have to reason through and like understand and like to figure out like how much should the price appreciate in a given day and why, and like how does it actually mechanically under the hood change. And so there's like a big on-chain knowledge gap that I think needs to be solved. I think, one of the things that is a huge void, and this is probably not something that I think anyone in this room is going to quickly solve, but one of like the huge voids is when it comes to like regulation, the venues to actually trade RWAs, which are all without question securities and fall into securities laws, are lacking. We see very little actual DEX activity. I mean, none for the most part. We see very little, centralized exchange activity with RWAs. Like right now, if you look at like, how can you actually trade this stuff? Like you kind of can't. And this is like a huge hairy challenge.
Just breaking down the DEX how much of that do you think is, just the lack of the DEX or like other issues like privacy and things like that?
There's all sorts of issues that go into it, but like basically like trading for RWAs in general right now is like microscopic. Barely exists. So that's a huge problem. Lot of reasons why that's the case, but like, the trading for a ERC20 token that somebody made up 2 seconds ago and just deployed the token contract, trading pops off, right? The amount of trading for an extremely high quality asset that tokenizes an off-chain asset, very minuscule to non-existent. And like, that's a crazy gap in crypto that should embarrass everybody, like everywhere, is that the amount of trading for junk, starts off incredibly high, and the amount of trading for RWAs is like non-existent.
How about you, Nate? What would you like to see? Would you inspire these students?
I mean, my take on that in particular is like, we're not super focused on or excited about DEXs and RWAs because it's just not super core to our thesis in terms of like what the right ordering for all this stuff is. And as such, like we're focused on bringing that liquidity that already exists for these traditional assets on chain. So we really want to see, on-chain financial protocols that over-collateralize things like loans, derivatives, and other products using tokenized securities and potentially crypto as well. I mean, I think there will be a lot of exciting early use cases that take advantage of cross-collateralization between crypto and securities and offering, retail prime brokerage-like experiences. So it's a little bit hard to give examples today without our offering, which is going to make a lot of this possible, being available yet, but definitely looking forward to a resurgence of DeFi built on, more liquid tokenized securities.
So a rich RWA ecosystem emerging.
So the future generations of Compound, or maybe Compound itself, with securities.
Amen.
Well, that was it for us. Thank you so much for your time. It was really insightful just to dive into RWAs with all of you, and thank you for all being here.
Thanks, everybody.
Thanks a lot.